Welcome to It's the Economy. Let's swerve from stocks for just a bit and look at the interesting happenings in the bond market. Indian and Asian bonds and currencies have been facing some unexpected challenges, as we all know. The most important is the sharp rise in US yields by about 130 basis points since May. Even as US yields have eased a bit in the past 24 hours, the changed geopolitics in the Middle East raises fresh fears over oil prices. That has an impact on Asian bonds. Separately from all this, Indian bond yields have been pushed up by a hawkish-sounding Reserve Bank. The central bank in its policy last week said it plans to do open market bond sales. That's terrible for the bond market. The announcement pushed up yields by almost 15 basis points. That means it hurt much more than US yields and crude oil prices. To give us a perspective on all these issues, I have with me Chetan Ahya, the chief Asia Economist at Morgan Stanley. Chetan, good morning. We have our plate full over here in terms of issues. But first, let me begin with the US bond yields. This time, Asia, according to your report, is not going to be impacted much?
Yeah, that's right, Latha. I think, bulk of the rise in real rates that we have seen in the US has been driven by the fact that, term premiums have gone up. Markets' expectations on the Fed policy rate hikes have not been much. So that is one important difference in terms of the rise in the US yields this time. The second is that Asia's inflation outlook has been still quite comfortable. We are expecting that Asia's going to see 80% of region's central banks having inflation within their comfort zone or closer to target by end of this month when you get the data for September quarter. Everybody's inflation would have looked like it's within central bank's comfort zone. So Asia does not have that big an inflation problem. And so usually the way we think about this dynamic when US rates are going up is the fact that whether Asian central banks have their policy setting in a way that the macro stability indicators like inflation and current account balance are in a good position. And when you try to answer that question, the answer is yes. Most of the countries in the region, except for Philippines, have inflation and current account balances in a shape that central banks don't have to take up interest rate hikes. And so this is the main thought process behind which we are saying that, look, Asia's macro stability indicators are in a good shape. We don't think central banks have to respond to this rise in US interest rates with higher policy rates.
Okay. They may not do it with higher policy rates, but will they have to postpone rate cuts? I mean, can you really cut, say, Indian repo rates if the US yields are still climbing? Never mind even if the Fed has stopped. If the yields are climbing, will that be a bit of a challenge for the currency and therefore will RBI desist from rate cuts?
That's right. I think so. We don't think that the central banks in the region will be able to cut interest rates when the US rates are rising up or, the dollar is strengthening too much with Fed rate hike expectations going up. So that's the reason why we have most of the region's central banks, which are about to be able to cut rates, will delay till second quarter of next year. So that's the quarter ending June 2024. Because we also expect that by that time, Fed would have indirectly or directly indicated that they are not taking up more rate hikes and that they are actually about to cut interest rates. So we will need that confirmation from the Fed that Fed is done with this tightening cycle and it's about to embark on an easing cycle for Asian central banks to also be able to cut rates. But look, I think the reason why we are thinking about some modest rate cuts in the region is that you will have a dynamic where inflation would have decelerated quite a lot and real rates would have been rising. That would be sort of away from the policy stance which various central banks would have, i.e. that real rates would have implied that you are doing tightening of monetary policy when it may not have been warranted.
Okay. I'll come back to Asia and India in just a minute. But what is Morgan Stanley's in-house view on US yields itself? This move in the 10-year from, 3.5% in May, June, all the way to 4.85 was quite unexpected. And there has been a knee-jerk 20 basis fall. So is a significant retracement expected? Or, is the medium-term range likely to be towards 5, simply because there is fiscal oversupply?
Well, we are expecting rates to moderate from here. And our thought process is that if you break up the 10-year bond yield trend into policy rate expectations and term premium, both those aspects we think will support 10-year bond yield to go lower. But the most important driver to our lower rates forecast is that the Fed will be cutting rates in the next calendar year by about 75 to 100 basis points, and that's what will create that environment for U.S. 10-year rates to go down. So we've been of that view, and you're right, the recent rise was a surprise, and it was not in our forecast. But our U.S. rates team is still maintaining that the trajectory of the 10-year bond yield is downward, more closer to a 4 handle rather than staying at 5%.
Okay. 4 handle, that's still a long way if we have to get to closer to 4%. But Chetan, coming back to India, how do you assess the Reserve Bank's response in the monetary policy? Why would they announce such an important step like an OMO, an open market sale, that has pushed up yields considerably? Should that be read as a defense against US yields?
Yeah, I would think so. I think the way we are seeing various Asian central banks is, some of them are explicit, like BOK, which mentions about the Fed policy path and what is happening to the US rates. And RBI has been sort of more focused on the domestic inflation. But it's very clear that somewhere in the back of the mind, the developments in the US rates and the Fed policy outlook is weighing on RBI's mind as well. And in an environment where oil prices had been rising, at least at the time when a monetary policy decision got taken, they would have to be considering the fact that you have a combination of higher US rates, i.e. higher dollar, and higher oil prices, weighing on the inflation outlook. So they didn't want to sound in any way indicative that they are done and they are going to cut rates, because that will ease financial conditions and that will risk that the currency would depreciate. And I think that's really the main driver behind RBI's increased hawkishness. We don't think that the underlying inflation dynamic in India is right now warranting that shift in hawkishness, but it's the outlook of that inflation affected by this, potential dollar rise and higher oil is what has weighed on RBI's mind.
Okay. Well, I'm not trying to ask you your view on the new geopolitical problem in the Middle East, the Israel-Hamas war, but will Asia have to struggle with higher crude prices? Is that one of your base cases?
So right now, our oil analyst is not forecasting oil prices to rise meaningfully. Our forecast is that oil prices will average around $95 in the fourth quarter of this year and then head towards 85 next year. So we are not expecting oil prices to go up in our base case, but if it does go up because of these geopolitical tensions, I think it will definitely complicate the monetary policy management in the region. And so in that scenario, while I mentioned our base case, we're not expecting rate hikes, we're in fact expecting rate cuts to be happening, though in a delayed manner. In this risk scenario where oil prices shoot up, we will see that there is a possibility that some of the central banks may have to take up a rate hike.
Okay, what's your RBI rate cut date?
So we are forecasting rate cut in the second quarter of 2024, and we are expecting just about a 50 bips cut. So it will be a shallow rate cut cycle.
Okay. When you say second quarter, you mean second calendar quarter, right? April, May, June.
That's right. April to June quarter.
Okay. A final question on growth. The US yields are high. We hear about problems in the commercial real estate. and with the 10-year yields, with the term premium also rising, is there a chance that US growth and therefore global growth gets impacted? What would your take be for India itself if the global impulses are going to be weak?
So look, firstly on the US, we are expecting growth to slow from the fourth quarter, this quarter itself. There are a few things that are going on in the US. One is, of course, that real rates are rising, and so monetary policy is gradually tightening. Second is that we don't think we will get as much fiscal support, and so fiscal impulse is not going to be positive like it was in the last 12 months. Number three is that, there's going to be the student loans repayment that will burden the consumers. And finally, the excess savings stock for the bottom 20% has exhausted. So we are expecting consumption slowdown and overall growth slowdown in the US. In the context, this recent real rate rise has only added to that downward pressure because the US economy is funded to a large extent with long tenure borrowing rates. And so therefore, we think that case that we have in our base case that there will be a slowdown is only getting more confirmed. Now, as far as India is concerned, this may not be a bad thing. So as long as the US is slowing but not going into a deeper recession, it will be good for the region and India in the sense that it takes off this pressure of dollar rise and US higher rates, but brings it down into a situation where you don't have a big downside to exports growth. So soft landing in the US, even if it may be a deeper slowdown, it's fine as long as you don't get a deeper recession.
Okay. So Indian growth, what's your number now?
So we are at 6.4% for the current financial year. And the next financial year, we are at around the same number, 6.5% on an average.
Okay, I'll leave it at that. Out of time, Chetan Ahya, pleasure speaking with you. Thank you very much indeed for joining us with your views on US yields and how Asia and India are likely to get impacted. The short answer is that this time the impact is much less, especially for a country like India, where inflation is already trending towards not entirely, but towards the central bank's goal of 2 to 6%. And, the currency is supported by expected bond flows as well. We have to wrap up on Bazaar on that note. Chartbusters comes up next.